Hey guys, welcome back to the channel. In today's video, we'll be taking a look at some of the ways on how to find support and resistance levels on a price chart. Support and resistance levels are one of the most powerful tools that we can use in the stock market. But before we can use support and resistance levels on our price charts, we first need to know how to find and identify these support and resistance levels. And that is what we will be covering in today's video. The first thing that we'll be taking a look at is what is support level. A support level is a temporary price floor. So when prices reach a support level, prices have a higher probability of bouncing back up. And that is what a support level is. For a resistance level is a temporary price ceiling. When prices reach towards a resistance level, there's a higher probability that prices will likely to bounce back down. And that is what a resistance level is. On top of knowing what support and resistance levels are, we also need to know this support and resistance principle. That is, support becomes resistance when prices fall below that support level. So when prices break below the support level, this old support level becomes a new resistance. So when prices break below that support level and prices reach back up, that old support level becomes a new resistance level, and vice versa. When prices break above the resistance level, the old resistance tends to become a new support level, which means that when prices break above the resistance and pull back, the old resistance becomes a new support level and prices are likely to bounce up from there. To recap, support levels are like price floors. When prices reach a support level, there's a higher probability that prices are likely to bounce up from there. Resistance levels, on the other hand, are similar to price ceilings. When prices reach a resistance level, there's a higher probability that prices are likely to bounce back down from that resistance level. In the event that prices break below the support level, that old support level tends to become a new resistance level. And when prices break above the resistance level, the old resistance level tends to become a new support level. Now that we know what support and resistance levels are and their principles, let's use an example to apply what we have learned so far. Prices fell here and bounced back up from this level, fell again and bounced back up from this level. So this level over here is a support level. The next time the support level did not manage to hold prices and prices broke below that, it rallied a bit over here and bounced back down, rallied over here and bounced back down. So we say that that level was a resistance level. The old support level becomes a new resistance level when prices fall below the support level. And after that, prices managed to break above the resistance and it declined a bit over here. And because prices broke above that old resistance became a new support level. Now, let's take a look at a real-life example of this support and resistance principle on our price charts. This is a price chart taken from Think or Swim. And over here at the left side, prices form a new high. The new high became a resistance level. Prices traded below that resistance level for a bit before it finally broke above the resistance. And as we have learned, when prices break above a resistance level, the resistance level tends to become a new support level. And we see that playing out on the price charts. When prices broke above the resistance, the old resistance became a new support level. So prices managed to find support here and support here. And after that, prices broke below the support level. And the support level became a resistance level once again. So when prices reach a resistance level, prices are likely to bounce back down. Prices rallied again and it managed to break above the resistance, and then the resistance became a new support level over here. So for this example on Think or Swim, we see how the support and resistance principle plays out. When prices break above a resistance level, the resistance level tends to become a support level. And when prices break below a support level, the support level tends to become a new resistance level. The next important support and resistance principle that we need to know is support and resistance cannot point with 100% certainty whether prices will reverse at those levels. So support and resistance levels are not some magical points on our price chart that prices will automatically reverse when reaching those levels. What support and resistance levels do for us is that it gives us a higher probability of anticipating where prices are likely to reverse at. Even though support and resistance levels are one of the most powerful technical indicators out there, it works similar to other technical indicators in the regard that it does not predict with 100% certainty. Okay, now that we have known what support and resistance levels are, the support and resistance principles, and taken a look at some examples, let's take a look at the first way we can find and identify support and resistance levels on our price charts. The first way is to look at previous highs and previous lows. These previous highs and previous lows are potential resistance and support levels respectively. For potential resistance level, we want to look for previous highs. And for potential support levels, we want to look for previous lows. Prices rally over here to form a new high. And this new high is a potential resistance level. And after reaching the first high, prices decline a bit and then it rally back up again. And because the previous high is a potential resistance level, when prices reach that area, it bounce back down. So we can say that level or that previous high was a potential resistance level. When prices decline and form a new low, this new low is a potential support level. So when prices rallied a bit and then decline again, prices tend to decline back to the previous low and bounce back up from there because the previous low tend to become a new support level. So for the level, the previous low, we can say that it is a potential support level. One of the questions you might have is, why does resistance level tends to form at a previous high? The first reason is because of break-even participants, the second is the take-profit participants, and the third are the potential buyers. For the break-even participants, they bought close to or at the high. When prices decline after they bought at the previous high, the tendency is not to take a loss but to hold on to the stock for the hope of breaking even. So when the price returns back to the old previous high, these participants will look to sell in order to break even. And that is why resistance levels tend to form at previous highs. Because when prices reach the price level of the previous highs, participants who bought at the previous highs will tend to want to sell to break even. And that is why at that price level, there tend to be a greater supply of stock relative to the demand. The second reason why previous highs tend to be resistance levels is because of take profit participants. These participants bought the stock at lower prices relative to the high. And these old highs are potential areas to take profits on. Since prices managed to reach that previous high before, these participants believe that prices can reach back to the previous high. And that is why when prices reach back to the previous high, they will look to cash in some of their profits. And that is why at previous highs, there tend to be a greater supply of stock, which creates an area of resistance at the price levels of the previous highs. The third reason is because of potential buyers. When prices reach to the price level of the previous highs, potential buyers might think that prices are a bit too expensive at that price level. Because previously at that price level, prices did not manage to go above that price level, but instead fall from there. So when prices reach back to the price level of the previous highs, these potential buyers might think that prices are expensive at that level because based on past experience, prices are likely to decline from there. So these potential buyers will withhold their buying for that moment. And this creates lesser demand relative to the supply of stock at that price level. This also creates an area of resistance at that price level, and that is why prices are likely to decline from that old previous high price level. If we take a look at this price chart taken from Thinkorswim, we see a resistance level on our price chart. Previous high was at the left side of the price chart over here. And moving towards the right side of the chart, when prices reached this previous high level, prices encountered resistance and bounced back down. Let's take a look at the 3 reasons why prices are likely to decline from the previous highs level. The 3 reasons are because of the break-even participants, the take-profit participants, and the potential buyers. For the break-even participants, imagine these participants bought the stock at this level over at this side of the price chart. And after they bought, prices decline. These participants have a tendency to hold on to their stock because they do not want to make a loss on their stock. So they would hold on to their stock in hopes of breaking even. And when finally prices manage to reach back to their previous high levels, they are likely to sell this stock because they want to break even. So when prices reach back to the old previous high level at this area over here, those break-even participants will look to sell the stock. And this creates a relatively larger supply of the stock compared to demand over here. And when that happens, prices are likely to decline from that level. And say some of the participants who did not manage to sell at this first point over here, so what will happen when prices reach back to the old previous high the second time? Those who did not manage to sell the first time are more likely to sell at the second time. And again, when prices reach back to the old previous high level, because there were more supply than demand, prices are likely to fall from there. The second reason why previous highs tend to become resistance levels is because of the take-profit participants. Say the take-profit participants bought their stock at around this level over here. And after they bought, prices continue to rise for a while. And finally, it reached back to the previous high level over here. What these take-profit participants would do is they will tend to look on the left side of the chart to see where the previous highs levels are. So the previous high levels were around at this area over here. When prices reach back to the old previous highs level, these participants are likely to take profits at that level because they saw on the left side of the chart when price reached to the old previous high level, prices decline from there. So what these participants will do is that they are likely to want to take profits at that level. And because these participants will look to cash in on their profits, there's a greater amount of selling relative to buying. And this will create a downward pressure on prices, and that is why prices decline from there. The third reason why previous highs tend to become resistance levels is because of potential buyers. When prices reach back to the old previous high at this area over here, potential buyers who miss out on the earlier rally might want to enter their position. However, because prices are at the old previous highs, these potential buyers might think that at this price level, prices are a bit expensive. These potential buyers will hold back their buying for the time being. And because they hold back their buying, there's relatively lesser demand for the stock at this price level over here. And that is why prices are likely to decline from here. We have taken a look at why previous highs tend to become resistance levels. Now we'll take a look at why previous lows tend to become support levels. One is because of the potential buyers. Second is because of the reluctant sellers. When prices fall back to the previous lows, it appeals to potential buyers because it seems like a bargain. These potential buyers who may have missed the earlier opportunity to buy when prices were at that price level, now that the current prices are back to the previous lows, this presents them another opportunity to buy and enter their position in the stock. The second reason why previous lows tend to become support levels is because of reluctant sellers. After seeing prices bounce up from the previous low, these sellers are reluctant to sell at this price level again because they believe that prices are likely to bounce back up again. For this price chart taken from Think or Swim, the previous low was established at this price level over here. And after that, prices managed to rally a bit before prices declined. And when prices declined to this level, there were two main reasons why prices managed to find support at this previous low again. The first reason is because of potential buyers. These buyers may have missed out on an earlier opportunity to enter the position in this stock at this price level over here. And now that prices managed to decline back to the old previous low, these buyers who have missed out on the earlier opportunity may look to add their position at this price level over here. This will create relatively larger amount of buying and demand for the stock at that price level. And that is the first reason why the previous low tends to become a new support level. The second reason is because of reluctant sellers. After seeing prices manage to rally for quite a bit over here, when prices decline back to this level, sellers are reluctant to sell because just recently prices managed to reach quite a high level. And now that prices have declined, these sellers are reluctant to sell at this price level, which is much lower than what prices managed to achieve just recently. And this relatively lower supply of the stock at that price level means that prices are likely to bounce up from that price level. And those are the two main reasons why previous lows tend to become support levels. The second way to find and identify support and resistance levels on a price chart is using round numbers. Support and resistance tends to form at round numbers. And the reason is because round numbers might seem easy psychological and reference points for investors and traders alike to make their buy and sell decisions. Support and resistance levels tend to form at these round numbers. In this case for the SPX, there was a bit of resistance when prices were approaching the price level of $3,000. And when prices finally managed to break above the $3,000 price level, that old resistance at the price level of $3,000 became a new support level at the same price level. So support over here and support over here. This is another example of how round numbers tend to become psychological points where support and resistance levels tend to form. This is the price chart for the gold ETF. At the price level of $130, we see that this round number was a psychological point for investors and traders alike, where there was more selling at this price level compared to buying. This was the first resistance, the second resistance, and then we see on the right side of the chart, there was also the third, fourth, and fifth resistance. The second way to find and identify support and resistance levels on a price chart is to look at round numbers. The third way is to use trend lines. Trend lines reflect the underlying trend. In the examples that we have seen so far, the support and resistance levels are horizontal lines. Trend lines are a bit different. Trend lines are diagonal support and resistance levels. In a trend line, when prices reverse when it approaches that line becomes a dynamic support and resistance level. Over here, we see a pair of trend lines which serve as both support and resistance levels. The trend line below serves as a support level. So we see that prices managed to find support here, over here, and over here. And for the trend line above, prices found resistance over here, over here, over here, and over here. Trend lines are the third way to find support and resistance levels on our price charts. The fourth way is using moving averages. I have a video over here where I explain what moving averages are and how to use them in the stock market. In this video, because of the constraint of time, we will not be going through what moving averages are in detail. The important point to take note in this video is that moving averages also serve as dynamic support and resistance levels. For this price chart taken from Think or Swim, for the SPX, that the blue line serves as a dynamic support level. Prices found support here, over here, over here, over here, over here, here, and over here. So whenever prices reach that blue line, prices tend to bounce back up. And prices bounce back up from that moving average repeatedly in this example. So we can say that for that moving average, it serves as a dynamic support for the SPX. So in this video, you have learned what support and resistance levels are and the two important support and resistance principles. And finally, we learned the 4 different ways to identify and find support and resistance levels on our price charts. The first is previous highs and previous lows. The second is round numbers. The third is trend lines. And the fourth is moving averages. So those are the 4 ways to find and identify support and resistance levels on our price charts. If you have learned something from this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this in the future. And if you are new to this channel, make sure you subscribe to this channel so that you don't miss out on future videos on investing, trading, and the stock market. I'll see you in those other videos. To your financial success.